When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shea. I'm just here to ask the questions, but of course, the words of wisdom and solid advice, they come from the other Jeff in this radio program, Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, Happy New Year. How are you today?
Well, Happy New Year to you, too. I'm doing well. How are you?
I'm doing great, thank you. Of course, 2025 in full swing here. 4 days into the new year so far. Doesn't feel that much different from 2024, but we're early on here. Do you make any resolutions, either personal or financial or otherwise?
You know, I think everybody probably ought to, because, life is still kind of a process for most people. I probably don't do as many as I should. I try to make mine more like not, I'm going to lose 20 pounds, more like I'm only going to eat sugar once a week, like ice cream or dessert, and I'll do those things and maybe try to develop a habit that would make me get that end result. But sometimes you focus so much on the end result that you don't focus on the process or the little things that you have to do to get there. So sometimes, I guess lately in life, I've just tried to, do different things. Like last year I did portion control, basically more macro eating and, not necessarily dieting, but just pre-portioning food. And that has helped me lose over 20 pounds. And It was healthy. I haven't lost bulk. And, some of that has worked. But, all the years that I said, I'm going to lose 20 pounds, I very rarely did. It's like, or if I did, I'd work out really hard, try to do it really fast. And then I go, oh man, this stinks. I can't work out every day. And I sure miss eating second helpings. And boy, I sure miss cake and ice cream, all the kids' birthdays. You just do it and say, well, I need a free day. And then pretty soon it's like, why am I not losing weight? Or why did I plateau? But I think just, more like lifestyle changes rather than the end goals for me, as far as that goes for the health and stuff. Money wise, I always have goals as far as, I want to put away a certain amount of, my savings and that's more of a habit to live by. And it can be a percentage, not like I'm going to grow my net worth by $50,000 this year. If that's what your goal is. It's not like, well, the market can't do that necessarily for you. It might grow up by more depending on how much you have and how much the market, grows or doesn't grow. It might be how much can I save? And maybe it's just I'm going to always save a percentage off the top of what I earn. And if I have a good year, I'm going to end up saving more. And if I don't, I'm going to end up saving less. So I think sometimes we box ourselves into these specific goals that make it really hard to achieve. Over the years, I've just learned that that's a specific goal. I know some people are going to argue with me and say, oh, yeah, that was a big goal because you can never figure out all the processes and the pieces that you need to get there. For me, it's just, it works better the other way. And I think everybody probably has a different method. Sometimes people have to have a picture board. They've got to see the Ferrari on the wall so they can, work hard towards getting it someday, and maybe they'll never get it, but they'll always be striving for it. Maybe that's how they like their goals. I don't like to put unreachable goals out there on the board. Some people think, well, the universe will just magically give them to you as long as you visualize them. You have to do a lot of work in certain things. I don't think the universe just, ends up, just throwing out stuff. And I think if you don't think it or visualize it or have it in your mind, then you'll never, even start to do those things that will end up getting you there. But you can say, I want a Ferrari, and then you sit at home and watch TV every day. That's not, no matter how much you visualize, the universe is not going to give that to you.
I know.
So, I have a lot of, there's a lot of things, philosophies out there that I think have, come and gone that I think are foolish and maybe a little overplayed, probably because they're selling you something or some sort of a multi-level product along with it or something. I don't know. I guess I've gotten cynical in my old age as far as, how other people tell you to do goals. I think you have to figure out what works for you personally and do it.
Yeah, well, I would agree with you. It's all about the process, and statistics have shown, I saw a study that said that 91% of people fail with their New Year's resolutions because you said they're focusing on the end result, not the processes that'll get there. And, let's say that you want to walk 10 miles, something like that. If you just do 1% per day, eventually you'll be able to get to do that. So like you said, take it in small doses and you will more than likely achieve your goals. You'll have a better chance than if you try to eat the entire elephant at once instead of small pieces. Let's talk a little bit about the Trump bump. I know that we talked about that. It's over with now. Trump's win gave the stocks a lift that was unlike anything seen in past elections. Not even the market's jubilation following the 1980 victory of Ronald Reagan commanded the same percentage gains. But can investors expect that post-election shockwave to reverberate in 2025, Jeff? Or was this initial market glee just a case of irrational exuberance?
Well, I think a little bit of it was irrational exuberance. I think exuberance is well-founded. I mean, Trump did a good job for us, treating government more like a business than just a money game where you just take money and give it away to your friends. I mean, I think there's probably still a little bit of that. And I mean, I'm sure there's certain people that helped him get elected that probably are owed some favors, and that's politics, and I get that. But as far as creating an atmosphere and a climate and an economic system that would potentially make our economy better and support, I guess, the earnings that we lack in the market to help us somehow justify the valuations of where the market is today, I think Trump has a good chance of getting us closer than if we kept going down the same path, manipulating the market, saying everything was good when it isn't, and somehow, driving the prices of the stock market through the roof, even when earnings are growing at like 5 or 6% on some companies, yet their stock's growing at 50 or 60%. Well, when are we going to get those earnings? Those future earnings are going to come around to support that. Now, NVIDIA did over the years, although it's still way out there. They, I guess they consider that the company can continue to double forever. Well, no company continue to double forever. Small companies can, growth companies can if they're in growth mode. But once they get to that kind of that critical mass area, then it's kind of cruise. They become cash cows, kind of maybe where Apple and Microsoft, some of those bigger companies are, is that, to see them growing by more than maybe 10 or 20% in revenues would be probably, a really good year. Yet, their stocks can grow at 50 or 60 or 70% in a few months sometimes, which is, counterintuitive in my opinion. We've already had this irrational exuberance, through the market every time the Fed says, we're going to lower interest rates. Somehow lower interest rates means the stock market is going to go crazy. So let's just buy it now and overpay. And we don't care if the companies are making money or not. Some guy on the news or some guy on some talk show says, this is a buy, and so I should buy it. Well, people aren't really putting their brain power into, why a stock should go up and doesn't go up. I mean, obviously it's momentum. If there's more buyers than sellers, it'll go up. And somehow we're creating a lot more buyers, I think, with a lot of hype, not fundamentals. Trump has the ability to add some fundamentals, I believe, with lowering taxes, keeping money in play within the companies, especially corporate taxes, creating a climate where maybe less regulations, which may cost less for companies, give them more profits where they can hire people and increase employment for many companies, increase jobs, more people working, the better it is for the economy, more people can buy things and create an actual earnings increase for a lot of these companies that are struggling to keep their head above water right now. Even blue chip companies that really haven't seen earnings for a few years since COVID, just kind of plugging away, yet somehow their stocks are going up. I think the Trump bump was the market saying, yay, we're glad this happened. We think there's a good future ahead for us. But I think there's so much that's already been priced in. I think we need to be cautious and, not foolish, just chasing the money. I mean, typically, when we get in this euphoric state, that's typically what precedes the next market crash. And even without Trump winning or, Harris or Biden, anybody who was in play in the election a year ago, we know just based on the yield curve inversion, the private ownership of stocks, household ownership, savings percentage going down, debt going up, all the different things that basically say, hey, we're in an economic crisis here, are all getting worse. All those several things that I've always talked about, pretty often, culminate, and they always end up badly in a recession. And so, the Fed's been able to manipulate it probably an extra year or so. I think we started what should have been a good market correction and a recession in 2022. They kept printing money. They bailed out banks. They did all kinds of stuff that, the Fed can do, and they do because they don't have to play by any rules or bookkeeping rules or even good accounting rules for that matter. They can basically print money, give money, they borrow it back and pay people to borrow money back that they printed and gave away. I mean, it's just, how do you self-deal like that? But, I guess money makes the world go round, and money momentum makes the economy look strong, whether it is or not. The banks get richer, the big companies, and Wall Street, benefit by it. The public, maybe not so much, unless you've got enough money to have a chunk in the stock market, and if you can get out before it crashes, right? And that's a big thing, is we can ride this, train along just fine until it derails and goes off the tracks, and then what? Hopefully you're not caught, holding the bag. Right now, We're seeing a ton of insiders, meaning the CEOs of companies, directors, all kinds of insiders, meaning the people on the inside of these companies are selling at record paces never before seen. So if they're getting out of the stock when the stocks are going up and everybody's saying buy, 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 but they're the insiders, the people that know what the stock should be worth, even Wall Street, even the banks are selling into this, hyping it to the public. The public's going crazy and they're selling, and they've been doing so for the last year or so. So the fact that there's a Trump bump hike, I don't think the Trump bump is being supported much by institutions who know better and understand that the valuations of the market are already way overdone. I think it's mostly by people that are really happy the election went their way. They were frustrated with inflation, politics, with how far the left was going to tax and spend and create a climate that was going to be even more and more difficult to get ahead going forward. And when that crisis was averted by an election that put Trump in charge, I think the public got happy and said, oh, yeah, let's spend our money in the stock market. It's going to go great. Well, we noticed that for the first few weeks, the market did very well. But in the last few weeks, it didn't. Usually we get a Santa Claus rally that includes Christmas through the end of the year. We had a couple of good days, but most of the days were sell-off days. And then there was some manipulation going on with, futures buying with what we call the plunger team in the White House, basically the economics, the people that play with the Fed and play with the banks and decide to buy futures before the market opens to make it look like it's going to be a good day. Sometimes they sell futures and then people start selling, then they buy cheap. And it's just a big manipulated game. If people really realized how much the traders or the people on the public or the retail end of things are puppets on in Wall Street's control, I think they'd be a little bit more cautious. Now, I'm not saying that the stock market's a horrible place to play for everybody. It's just a bad place to play at the valuations where they're at, even after the Trump bump, because we've already seen it soften. We've already seen it kind of give up some of the gains. And we've seen it just not be quite so robust. I mean, we saw Bitcoin go to $100 and then it's really struggling to stay at that range. It keeps on selling off and, try to creep back up there and then it sells off. So there's a lot of things that got a big injection of adrenaline that I see kind of waning. And again, if I go back to the 2022 year when the market crashed and they basically pumped a bunch of money into the economy, the yield curve inverted, the increase of money, which all basically went to rich people buy their own stock. Companies did a lot of stock buybacks, which pumped the market up. So there's a lot of growth in the market cost, but there hasn't been a lot of growth economically. And we still need that reset or that recession to happen if the cycle is going to complete. And so far in history, the cycle always completes. And generally speaking, it's after the Fed starts lowering interest rates. And it's also after the yield curve inverts and stays inverted. Well, guess what? Even though the Fed has lowered interest rates, they've only been lowering the short-term interest rate, and that just basically gives the Fed the ability to trade and to borrow money for banks at a lower rate so that the banks can profit. But they've increased interest, which is inflationary, which actually helps rich people. It helps the banks. The banks can charge more for interest on their loans. Credit cards can justify charging more higher fees and higher interest. You've got people that invest and collect art, cars, all those kind of things. Inflation actually increases the value of all those things. So the rich get richer because they're kind of manipulating interest rates to be up. If you look at what really happened since the Fed has lowered interest rates 3 times now, that the long bond, the 10-year and the 20-year, the bonds have gone down, meaning that the yields have gone up, meaning the interest rates keep going up. So car loans are higher, mortgages are higher. Refinancing any type of debt's going to cost you more than you thought it would in the face of lowering interest rates. But what that means is long-term interest rates are going up, which is where they typically are compared to the short-term interest rates, which are going down. Guess what? The yield curve, uninverted, the yield curve is actually where it's supposed to be. The 10-year yield pays you more than the 3-month yield now for the first time in a few years, about almost 2.5 years. It hasn't ever gone that long before. But I think the extra manipulation, the gamesmanship that the Fed was playing this last year or so, has kind of kicked that can down the road a little bit. But bottom line is it always ends badly in a recession. It's going to end up happening on Trump's watch. I don't know what he can do to avoid some sort of a reset, especially if he allows some sort of market forces to, control the markets, or in other words, allow them to get back to reality. I don't think the Biden administration wants anything to do with having the market soften on their watch, and they're almost, they're just days away when they don't have to take the blame for anything bad that happens in the market, even though, it's kind of softened up near the end of the year. And so far it's starting out, a little iffy, but we'll see what happens after the inauguration. If, the Trump bump can reestablish itself, or if we're going to have some sort of a sell-off and a day of reckoning where, the market meets reality and we have to kind of reset our thinking into, okay, the reality is, we don't pay $700 for $1 of earnings in a company anymore. We pay $30 for a dollar of earnings in a company back like it used to be. And, that's more of a realistic viewpoint, I think, in the market. But what that also means is there's going to be a lot of people holding the bag of overpriced stocks. They're going to have a correction, and hopefully they've got time to ride it out, or they'll at least be taking profits along the way. You never get hurt taking a profit, but if you take profits along the way, you're not going to get hurt as bad. Or if you put your assets, take some of the profits and put them in accounts like we've done over the last couple of years, where if the market does well, you do well. You don't lose money if the market does bad. So if I'm wrong and the market keeps going up, we still have ways to make at least a decent rate of return. If the markets get horrible and go down, then we don't lose our money. And, depending on where you're at in the cycle of investing and the cycle of saving for retirement in your retirement plan, kind of dictates how much assets, and it might just be a comfort level. You might be, ready to take some profits off the table, even if you're in your 30s or 40s, because you just don't like what you're seeing. But especially if you're already retired, you don't have a job to go back to and a way to earn back the money that you could lose in the stock market. I'd be very cautious here. So to answer your question, is the Trump bump over? I don't know that the Trump bump's over. I don't know if the Trump bump was even real. The Trump bump was just really saying, hey, we appreciate the election. We think things are going to be better in the future. Let's make them better right now for a few weeks. And that's what happened. But a lot of those sectors that got better right out of the gate, like energy, has already softened up and, gone downhill quite significantly. So, some of the stocks that were, growing like crazy right after the election are the stocks you should be shorting or selling right now. And, maybe taking some cover or rethinking what's going to happen to that particular asset class going forward.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about stock market projections, the forecast for 2025. Listening to the program today, you'd like to get in and sit down with Jeff and ask your questions that you need to put you on a path towards a prosperous retirement. Maybe you've got questions about the market. Change is coming here in 2025 that would affect you and your ability to retire. Anything that you want to know about, Jeff certainly will have an answer for you. So take advantage of the opportunity right now to get your no-cost, no-obligation Premier Retirement Roadmap. Again, it's not going to cost you a dime. To get it, call 520-780-9059. It's 520-780-9059. You can make that call this weekend if you'd like. All you've got to do is leave your name, telephone number. Shelley will pick that up in the next day or so. She'll call you back and find a time that is convenient for you and Jeff to chat. Again, you've got questions, we've got answers. Jeff Hogan is standing by to talk to you about your individual situation. 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, it's been thought that technology is an industry that should gain ground in 2025 as far as the market goes. What are some of the other sectors you think that are going to be prospering the most in 2025?
Well, there's a lot of sectors that are a little overvalued. I think it's a little counterintuitive to think that, because Trump is an energy, we want to be self-sufficient in our energy. We want to not have to worry about relying anywhere outside the country for that, OPEC, all that kind of thing. We want energy independence. And that's drill, baby, drill, and that's going to create a lot of maybe opportunities for more employment in the oil business, maybe a lot more infrastructure growth in the oil business. Maybe the pipeline business will do better. Maybe the transports will do better. I don't know, however, if it's going to necessarily make the cost of oil and gas go up. And sometimes it's basically more expensive oil and gas that actually creates more and more profits because it's really kind of a percentage, markup that most of these companies do. So I don't know that. I would say that be careful about just the idea of oil and gas prices going up. We've already seen the price of oil, falling pretty significantly lately. I do think, however, the transportation, if we're going to be energy independent, we're going to need to transport everything from gas. There's a lot of good stocks and a lot of good companies that are basically pipeline companies. There's companies that have railroad, through the railroad cars will transport everything from gas to oil and so forth. And that market will definitely grow and probably become a lot more robust. It might not happen within a week or two. It might even happen in a couple of years. The other thing I think is going to go really well for America is I believe the industrials or materials, things that where we can manufacture stuff here in the States where the tariffs are not a negative thing. They're kind of a a bargaining chip that Trump has to use to help other companies kind of comply with a lot of things. He can get his his message across by with threatening tariffs, and he's done that in the past, and I think he's already getting some people to bend a little bit in their thinking so far already. But the best thing I think tariffs do is it creates a situation where we can be competitive again on the home front. Manufacturing has fallen, I think, for the last 2.5 years, it's fallen like all but maybe every 1 or 2 months in every sector, in every manufacturing sector that they monitor growth in producing our own goods and manufacturing. So if we can get manufacturing jobs created, which are higher paying jobs typically than fast food and other things, we're going to see, a boom not only in incomes, but of also the ability for households to spend money, but also domestically, we're going to have profits on companies that are based here in the U.S., more profitable because they're able to actually build things here, buy materials here. And I think that's where we're going to see more of a, almost kind of more of an infrastructure, more of a manufacturing infrastructure development than anything. I think tech is really overvalued. I think there's still some big opportunities in the tech space. We've got robo-taxis and, we've even got air taxis through drones, and, the drone business is going crazy. I mean, look at some of those small stocks that are coming around. They've got AI software and quantum robotics or software computing that is growing because we're going to need all that kind of power to drive AI. So there's a lot of support systems that are coming around because of the AI chip in general. And of course, NVIDIA is the big player in that business, but they may be top heavy. There's a lot of up and comers that we see coming around, but I don't know that we know what small companies are going to be the next players. But I think industry wise, I don't think we can write off AI yet, but it's not necessarily the AI as we know, Chat GPT and just, trying to figure out and outguess, the next move in chess or whatever. I think it's more oriented to, I guess, structure around a lot of these like self-driving cars, the taxis, maybe the drones that fly through the air that, I don't know. I'm not really a tech savvy, crazy tech guy, but I see developments that are happening in industries and a lot of money being thrown at areas that look like they're going to be players in the future. And I think America is a great place to do it. I think America has a lot of those companies based here that can expand in maybe a less than overly regulated environment, where government doesn't decide who the players are and who the players aren't, that the free markets can actually work and allow the winners to be winners based on their own merits, their own production, their own business savvy, and what they supply to the marketplace, rather than a government interference type model that I think the other party is more prone to do. I don't think the government's going to be out of, some sort of play here, but Trump is not a overly regulation type guy. He's hey, hands off. Let's make sure nobody kills anybody doing this stuff, and let's make it a safe program. But let's let the market forces do what they do, and let's let the winners be winners instead of decide who those winners and losers are going to be. So, I don't know that I know the answer on where the market's going to go. I think there's going to be some sectors that really do well, and I think there's certain things that I want to watch. But I think those things will become apparent once we start seeing the policies that get put in play as soon as Trump gets elected. We're going to see a bunch of executive orders probably happen that negate a lot of the impediments to progress that I think Biden put in play. And, I'm not trying to be overly political here, but, I don't think the Biden administration was really business friendly. It was more government and crony friendly. Let's just pay back the people that got us elected and not worry about everybody else. And, collateral damage is okay. I mean, that's honestly the way I kind of felt like the whole administration, felt about me and most of my friends and my family. But I think Trump is a little bit more interested in the well-being of Americans in general. And I think there's going to emerge some areas of the market that are going to do well. And it's going to be readily apparent probably in the next quarter to 2 quarters. And I'll be watching closely to see what they are, believe me.
Well, when President Trump takes the oath of office for the second time here, I think within the first 48 hours, we're going to see a flurry of changes there. We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We have been talking about projections for the market here in 2025. If you have questions of Jeff, if you'd like to sit down with Jeff on a one-on-one personal basis and ask the questions that have been keeping you up at night. What should I do with my retirement funds? Is it safe to retire here in 2025? What are the changes that are going to happen that will affect me? You've got questions. Jeff is willing to sit down with you on an individual basis and answer those. It's called the Retirement Roadmap, and you can get yours absolutely complimentary, no cost, no obligation, by calling 520-780-9059. Make that call right now. Leave your name, telephone number. Shelley will call you back during the week and set up an appointment time that is convenient for you and Jeff. Once again, no cost, no obligation, so make that call this weekend, 520-780-9059. You can also find out more about us online at premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we've got listener questions, and then we'll talk about what you need to know if you're planning on retiring in 2025. When Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us each and every week for Premier Retirement here on 790 KNST for your fiscal fitness, your financial education. We've had a great program today talking about the stock market prognostication for 2025. If you missed any part of that program, you'd like to hear it again, we are a podcast. Go to wherever you get your podcasts. Search for Premier Retirement with Jeff Hogan. You'll find this show and many, many of our past shows on a variety of topics so you can stay on top of your wealth and how to grow it. Okay, Jeff, time for listener questions here. We'll kick it off with Sal listening to us in Tucson. Sal says, I'm 65 years old, retired, and living comfortably with no debt, no mortgage, no health problems so far. I just sold an investment property I owned for several years for $500,000 and would like to invest in the stock market, which I've never done before. I'm willing to take that risk. I have one daughter, which will be my only beneficiary if I let this account grow. My question is, am I too old to invest in the stock market? I figured I might live another 15 or maybe 20 years according to my family history. I have an appointment with Fidelity, but I'd like to get some input from you since I occasionally listen to your radio program and you always have good advice. So, Jeff, what would you tell Sal?
Well, it doesn't. If it's totally money you can afford to lose and just wait on for 15 years or more, maybe the stock market, can support that. Keep in mind, if history repeats and if there's a thing called the Shiller Index that basically says where the price-earnings ratios are today, what the next decade or so looks like as far as returns go, the stock market historically says, based on this index that's pretty true to form for, I think it's close to 100 years now, says that the next 10 years, the stock market will probably average less than 5%, even possibly negative, kind of like the last decade of 2000 to 2010. And that stands to reason based on how overvalued I think the market is. And you might want to, consider, is that a good enough return, or is that a good enough return to just hang on and, hope you live another decade and you get that big rebound decade? That's fine if that's the case. The nice part about stocks, if you use exchange traded funds or stocks that don't pay a lot of dividends but grow, is there's really no capital gains taxes due on those unless you're trading them and selling them a lot. So that's good news there. So basically, it's not taxed until you sell, and if they don't change the rules, which I think they're kind of lobbying to change, and some people are lobbying not to change the rules, where you get a step up in basis. In other words, a step up on what you paid for those stocks. When you die, your heirs, your daughter, which is the only beneficiary, would get everything on a stepped up basis, or in other words, tax free. Now, another way to circumvent the tax man and still get probably a reasonable rate of return might be that you do a LIRP, a life insurance retirement plan, something that you could, actually purchase over the next few years and have access to those funds should you need them on a tax-free basis. Maybe even so that your daughter, should she need a down payment on a house or help one of your grandkids go to college and you need a little bit of money, you can actually borrow from the death benefit, or basically borrow from that life insurance policy tax-free, and basically use the death benefit while you're alive. So you might want to say, what if that $500,000 would buy you, let's say, $1.8 million in a tax-free death benefit, some of which you could spend during your lifetime. Should you go to a nursing home and run out of other funds, you'd have access to that if the life insurance is on you. And when you pass away, whatever you haven't spent or used for your long-term care or used for a terminal illness or used for your health care or whatever other need you have would go to your daughter tax-free. And I think just based on where the market is and how overvalued it is, an indexed universal life LIRP type product, life insurance retirement type plan, or just we call it IUL, indexed universal life, will go up on the years when the indexes go up, and they won't go up when the indexes go down, but they won't go down either. Case in point, in 2022, we had indexed IUL, and I have a ton of clients in it. I mean, probably a third to half of my clients who, have a tax situation where they need tax-free income during retirement use LIRPs. So it's a very popular product here at Premier. So we understand how they work. But the nice part is, we didn't lose any money in 2022. And, in 2023, the returns were somewhere between like 2 and 8%, just depending, because the market was a little choppy depending on when they came in. But yeah, I've had a lot of clients this year because the market was really good, somewhere between the 12 and 15 range. So rather than losing 20, having to come back and make money, go all over the place in the last 3 years, even with a bad year and a mediocre year and one good year, we're still way better off than we'd be in a CD, still way better off than probably the typical stock market rate of return. Average rate of return should be over the next 10 years based on history. And it's all in a tax-free environment where if you need to get that money out, you don't have to pay tax on the gains. You just basically borrow against the future gains of that particular policy. When you buy stocks, ETFs, and other investments in the stock market, should you sell those, or should you have to sell them to get some money out for your own benefit, or even to, pre-distribute some assets to your daughter should she need it before you pass away? There would be a tax implication on any profits that you make on those sales, whereas there would not be on a LIRP alternative. So I'm just giving you two ideas. I don't think it's necessarily a bad thing. If you can afford to lose the money, it's not necessarily a bad thing to be in the market. I just think the market is at a place where you're going to be buying in high historically, and it'd be better to buy in low or to get into some sort of an index type product. Now, let's say you can't qualify for the insurance. What if you could get something that averages, say 6 to 10% rate of return if you back test it, 15, 20 years? Even if you look at what would happen over the 2000 to 2010 years, and still would have made 6% or better even during a decade where the market was flat, you could do indexed annuities as well, which are tax deferred, meaning you don't have to pay tax on any of that money until you pull it out. You do have to pay tax on the profits as you pull the money out. But if you don't touch it, you don't have to worry about it. If you do only pull it out in order to, pay for a tax deductible expense like healthcare or something else, then maybe those taxes are, a non-existent situation. So you might be able to get better tax treatment through insurance products. I'm not just an insurance guy, but I love to add insurance to our portfolio mix. But so many people only know about, CDs at the bank and stocks and bonds in the market, and that's really it. They haven't really looked at the idea that there are products that have been invented in the last 20 years or so from the insurance companies that give you the benefits of safety and protected principal, yet still upside based on the indexes of the markets and no downside in bad years. So it's kind of a retiree's dream. And I think it basically was invented along with, how so many of the baby boomers were starting to get retirement age and wanted something that was safer than the stock market, but not as boring and low returns as a CD. And the insurance companies came up and stepped up and came up big in that department. And some companies have come up bigger and been very innovative in the type of products that they provide. So you ought to look at a couple of different options and maybe you diversify into all three of them in some way with that $500,000. Maybe get a little bit of best of all three worlds and diversify into the different asset classes, not just diversify between a few different stocks.
Sal, thanks for listening to us in Tucson. Again, if you'd like to come and sit down with Jeff, 520-782-9059 is our telephone number. Make that call this weekend for your no-cost, no-obligation initial consultation. It's called the Retirement Roadmap, and we'll be sending you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Carly in Marana, and Carla writes, my company offers a 25% unlimited match for a 401k. That means they'll match up to the full amount the government allows you to put in at a 25% match. So if I put in $30,000 in a year, they would contribute $7,500. I know that's free money, but does it make sense to put all my investments in one basket of a 401k? Are there risks to that as well? I'm over 50, which is why I can put in that much each year.
Yeah, and I don't know if this is all the money that you can put away and you're over 50, maybe you've got another 10 years or so before retirement. I think dollar cost averaging into the stock market is, not a bad thing. Here's the other thing. You don't have to invest in risky stocks in the 401k if you want to diversify between, something that's a little bit more low risk. I wouldn't say necessarily 10-year bonds, which are actually going down in value right now because interest rates are still climbing, is necessarily a great investment. But you can go, somewhat conservative where you don't have everything out there like your neck out on a chopping block should the market crash. Even in a 401k, there's things that have, short-term interest, that could at least protect that asset. I mean, if you're going to make 25%, basically 25% on your money. You don't even need an interest rate. I mean, put it in the money market or the cash account, still get the 25. And here's the cool thing. When you are 59 and a half, which I don't know, you're in your 50s, but I don't know how many years you have till you're 59 and a half, chances are that 401k will allow you to start pulling money out, including the part that's matched, as long as you're vested in the company. If you just barely started there, you might have to wait 4 or 5 years before it vests, or 10 years even in some companies. But that's a pretty healthy match. I think you'd be foolish not to take the match. Especially if your only other alternative was to, call Fidelity or Vanguard or something, and just invest in a whole bunch of mutual funds and do pretty much the same thing without probably a lot of people do this without a lot of guidance from even an advisor, and just go out and, throw money at the market and see what happens. The 401k, unfortunately, typically doesn't come with an advisor either, but, you do have, certain asset classes or risk classes that you could pick from that would be more appropriate. Now, if you have more than 30,000 a year that you can put away, then look at other alternatives that aren't all in the stock market or all in the 401k type of investments to diversify into. You might want to try index annuities to build your own pension with income riders. You might want to try LERPs for tax-free income in the future, or even a death benefit to provide assets to loved ones should you die prematurely. There's other asset classes you might want to consider in a comprehensive plan that we would talk to you about. If you were to come in here and show us your whole picture of where you're at, where you want to be, and whether or not this $30,000 a year makes perfect sense. I never would not take the match. Now, based on your description, it's 25% of whatever you put in, they're going to put in. That's fine. Now, if it's some people do a match of your salary. So if you make $100,000, if they were to match 25% of your salary, that would be $25,000 in addition to the $30,000 you put in. That would be so killer good. You would not want to ever not do that. But, other companies will do like 4% of your salary. Well, if that's the case, then maybe if you're making $100,000 a year, you put in your $4,000, let them put in their $4,000, and maybe you take the other $30,000 that you were going to put into the 401k and look at alternatives outside the 401k to invest on your own in a place where maybe you either have better protection with some upside, maybe better income planning for the future with guaranteed income. Some annuities will do that. I know some of you think the annuity is a bad word because Wall Street hates it. Well, Wall Street thinks it's a competitive product. Yeah, a lot of people put money in annuities. They don't go back in the market because those annuities are going to create income streams for them when they're retired. And again, annuities are not a bad thing. They're to be used like everything in moderation and to the extent that it benefits you. I mean, too much of anything is probably too much of, it's even too much of a good thing, it's too much of some things. But, I don't think the stock market is necessarily a bad place to play as long as, again, you can afford to wait out the volatility and you're not putting more money in there that you could afford to lose or wait on. The annuities will create income. LERPs will create tax-free income and a death benefit to cover loved ones. So you've got all kinds of different options that you could do with that $30,000 a year. But if they're going to match you 25% only if you put the $30,000, I think you need to try to do that if you can, at least while you're working, at least till you're 59 and a half. And at that point, try to re-diversify out of that 401k into some self-directed IRAs. That's honestly when most people come to see us, that's kind of at the point where they're at and where they're saying, okay, now I know I have access to my money. Now I need to make a plan. Well, let's make a plan. If you want to make a plan before you're 59 and a half, that's even better because then at least you know how to set all your ducks in line and, make sure that everything remains in place.
Carla, thanks for listening to us in Marana. And once again, we invite you to come in and sit down with Jeff. Get your complimentary Premier Retirement Roadmap. 520-780-9059 is the telephone number. Okay, Jeff, next question is Art listening to us in Green Valley. And Art says, I'm in my late 70s and partially retired with a 60-40 stock to bond split. With a possibility of volatility in the market, is it time, do you think, for me to park these funds somewhere safe?
Well, I think as soon as you start asking the question, you're already uncomfortable. And as soon as you're uncomfortable, you shouldn't continue to be uncomfortable, especially in something that could, really take your head off when it comes to financially, it could be brutal. 60% in the stock market. Now, you've probably done well on that 60%, after the 20% plus correction in 2022, you probably made some of that back. The problem is the 40% that were in bonds went down, started coming back, and now they're down again. I mean, most of the long bonds, depending on what bonds you own, anything corporate 10 years or longer is still down about 20% from its highs in 2022. So you've got, 40% of your money down 20% that hasn't come back yet. Will it come back? Do you want to, hang out in bonds till it comes back because you don't want to lose money? I don't know. My opinion is there's a few other ways where you could take what you have, reset it at a place where no matter what, it's at the bottom. Because if the market keeps going up, you keep making money. If the market goes down, you don't lose any of what you've already got. And I would venture to guess that with that 60% in the market, depending on how you've invested it, you're probably overall in a better place now than you were a couple of years ago, especially after the market tanked in 2022. So you never get hurt taking a profit. I would consider diversifying. If you like playing the market and making some stock picks and trying to, swing for the fences on a little bit of your money, maybe if you've got, I don't know how much you have, but let's say you have $1 million in there, maybe you take a couple $100,000 and keep that in your 60-40 split that you can watch and wait on, and maybe you take 800,000 and stick it in a safe place that can only go up from here, and maybe average you 5 to 10% a year for the next decade or so with no risk. So if that makes sense to you, then you would get along here, because that's what we do for our clients in a big way. Typically 60 to 80% of people who are retired, nervous about the market, are going into safe places that still have upside. And 20 to 40% is still kept in a liquid spot where we can still try to take advantage of upside in the market when it's good. Sectors when they look promising. Maybe after Trump gets inaugurated and we see some of the policies and some of the favorable sectors that are going to prosper during his administration, then we want to rotate into those sectors and take advantage of that. But we need a little bit of liquidity to do that. We can't just do that with money that's in fixed accounts that are guaranteed with principal protection. We got to diversify into a little bit of everything here. So I think you're thinking the right things. You're thinking it for the right reason, and that is because you're getting older. Your risk tolerance is getting less and less, and you don't want to lose money. So I think you're smart to ask that question.
Art, we appreciate you listening to us in Green Valley. And, of course, 520-780-9059 is our telephone number if you'd like to come in and sit down with Jeff. If you have a question for us you'd like us to answer on the air, you can get it to us by calling it in to 520-780-9059 if you wish. You can also go to the website, premret.com. We have a contact page there. Leave it there, and if we use your question on the air, not only will you get a great answer, but you'll get Jeff's book, Retirement: The Road Ahead. And while you're at it at 520-780-9059, ask for your no-cost, no-obligation Premier Retirement Roadmap. Not going to cost you a dime. Just a casual conversation with Jeff to get the questions answered that you need to put you on a path towards a confident retirement. Once again, no cost to this. Complimentary, no obligation whatsoever, 520-780-9059. You can also request your appointment online at premret.com. That is premret.com. Jeff, a brand new year, and I'm sure that a lot of people are thinking about a brand new phase of life for them that's called retirement. If someone is listening to the program today, or someone comes into you, Jeff, and they're thinking to themselves, I'm not sure if I can retire. I'm going to go talk to Jeff Vogan about that. What sort of a process would you run them through to make a determination as to whether they can retire?
Well, I think they have to have a pretty good idea of what they can live on. And sometimes people don't. And what we can do is say, well, what assets do you have? And how can we convert them to assets that guarantee income, assets that have a good chance of predictable growth without too much risk? Maybe a certain bucket that we fill with long-term risk money. Maybe we've got a self-directed donor advice fund for charitable gifting, or that we can invest in. Maybe we've got some goals that we want to spend $150,000, but we want to pay taxes as if we only make $50,000. Well, then we need some. Maybe do some Roth conversions and some planning where we, pay taxes now and, don't pay taxes anymore going forward. We can lock in some of those assets to guarantee lifetime income over and above what we believe is guaranteed from the Social Security Administration. Some people would beg to differ, and I'm not sure how the trust fund is going to be reconciled, but I think I just really don't think that the government's going to allow that program to go broke. There's too many people. Well, I guess they're unproductive people that aren't working anymore, as Bill Gates would say. Who cares? But the fact is they're still productive citizens. For example, they buy stuff and pay taxes, and they're certainly productive. I think it's interesting how, I don't know. Some people think, well, they don't really need all that Social Security. Look at it. If they've got other means, then maybe we can tweak the Social Security. I mean, there's rumors happening that it might be means tested in the future. I don't think it will be. I think it'll continue to play out like it was planning. They're just going to have to either put extra taxes on the employers, maybe the employees. I think, the people still working and the employers that are still hiring are probably going to end up having to pay the brunt of that. But bottom line is you have certain assets or certain incomes that are guaranteed, or we can consider guaranteed in a plan. When we get that plan set up, say, oh, if you put this much here, this much here, and this much here, we can get you $120,000 guaranteed income, and $35,000 predictable income based on history should play out pretty regularly. But if you can bare minimum live on 120, you want to live on 150, and we can get you there and still have your assets. Let's say you have a $2 million estate, and we see that through projections of very minimal rates of return, you can still have $3 or $4 million, when you die in 20 or 30 years. that means you're not actually spending down the nest egg. Now, in some cases, we might spend them down on purpose while other assets grow. But bottom line, as long as your net worth is growing and you can come up with this $150,000 lifestyle, then maybe you say, oh, well, shoot, I'm living on 110 right now. I'm sure I can make it on 150. And sometimes just doing the income plan will open your eyes and say, oh, I can retire because look I've been a good saver. Shoot, I have some people that have never made more than $50,000 or $60,000 in a year. There's 2 household incomes, so they've maybe pushed 100 after withholdings and savings. They probably live on 60 or 65,000, but they've been good savers and they've got over $1 million in savings. And between Social Security and savings, they can create an income stream that would be somewhere between $100,000 and $120,000 a year. And if they're in their 50s and think that they have to work to their 60s, but they can retire right now and have $120,000 a year, which is more than they've ever had before, then maybe they've got an incentive to say, hey, you know what? I don't have to go another 10 years, man. I'm just going to take off and enjoy life now while I'm young and can still do it. As long as you don't go overspending and as long as you lock in some of those assets into guaranteed principal protected accounts. And that's why I like to use the insurance side of the business. It's there for you. It's there to create personal pensions. We use it for that reason. Now, we use Wall Street for growth. We use Wall Street for getting to retirement, not necessarily all your eggs in that basket to get you through retirement. Obviously, opposite the opinion of some of the big money managers that only do Wall Street investing who think that you should never buy anything other than their managed portfolio. As long as you don't take more than 3 or 4% out a year, you'll be fine. Well, what if you want to take 6 or 8% of it out per year? And if you have principal guarantee, you can do that. In other words, live on twice the income that some of these Wall Street firms say is more of a safe range. They just want all your money in management. They want to get fees forever, and they don't want you to spend as much as you should be able to spend, especially since you were the one that sacrificed and saved it all those years. You should be able to spend as much as you want within reason, as long as you structure it to where you're guaranteed not to run out of money and have a buffer so that if you have a bad year or two or a kid that needs help or an unforeseen circumstance, healthcare-wise or other, that you've got some sort of coverage for it, some sort of a backup plan. We wouldn't put you out on a limb saying, oh, you got to live, spend every last dime by the time you're 95 years old. Hope you don't live to 96 and hope the market makes 6% exactly every year and never loses money. I mean, that kind of a plan is not going to work, especially not after, what we've seen in the last few decades where we have lost decades. We have, years where we make a ton of money and years where we lose a bunch of money. You can't do that on a market-oriented plan. You got to be a little bit more focused. And you have to be a little bit more principal protection oriented and income oriented when it comes to deciding if you can retire. But a good place to start is kind of figure out what you've been spending, what you've been living on, and see if you can make the assets that you have overcome that with some buffer for, a short year, a flat year, or just the unexpected experiences that happen. And if you can, then you can get comfortable and say, well, great. Now I'm working because I want to, not because I have to. And I can retire anytime I want because Jeff said we've got enough money. And as long as we're not going to risk it all in the market for the next crash, we should be okay. And that's kind of our approach. Not everybody comes in here that finds out they can retire next year, retires next year. Some of them continue to work. But like myself, when I found out that I had enough money to retire, I didn't have to do this anymore to make sure that I was okay for retirement. My job got fun. It got way more fun when I do it because I want to, not because I have to. And most people's jobs are the same way, regardless of whether or not they're self-employed like me or whether or not they have employers that they have to answer to. They have to answer to them, but they know in their mind that they could just, basically throw in the towel and say, sorry, I'm out. And they could just walk and say, I'm retired. I don't need this job as bad as you need me. So see ya. I mean, just that comfort alone gives you the peace of mind, I think, to move forward and, feeling pretty good about things.
So if you're thinking about retiring here in 2025, again, you've got to figure out what it costs to be you, who you are in retirement and what it costs to do that. Maybe you like to fish off the bank, that's one thing, or maybe you like to go deep sea fishing, that is yet another thing. So what does it cost to be you? Then take stock of your assets, your income streams, your guaranteed income streams such as Social Security, a pension, that sort of thing, and then your other assets that could produce income. I would say also pay down those debts. Any debts that you have, I think, other than a mortgage, need to be paid off. Also, consult with a financial advisor such as Jeff on a withdrawal strategy for the funds that you have. And then talk about insurance, health insurance, life insurance, long-term care insurance. Where's that going to come from? And then I think the last thing is to decide who you are in retirement. We call that lifestyle planning. What do you want to do in retirement? You're no longer going to be defined by your job, but finally, you're going to get to be you. So a lot of things to consider if you're thinking about retiring in 2025. We'd like to help you with that decision. If that is you, call us here at Premier Retirement, 520-780-9059. and request your no-cost, no-obligation Premier Retirement Roadmap. Just a casual conversation with Jeff to ask the questions that you need the answers to put you on a path towards a confident retirement. Once again, no cost, no obligation for this, no judgment. 520-780-9059. Get 2025 off on the right start by making that call today. 520-780-9059. You can also find out more about us online at premrat.com. Well, Jeff, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our fine listeners for joining us. So for Jeff Hogan, I'm Jeff Shade saying Happy New Year. Thanks for joining us. Be sure to join us again right here next week for another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.